Stocks, for the most part, and risk assets since our last update earlier this week have traded in a very choppy fashion, largely sideways. And so I wanted to kind of prepare you and give you some tips of how you can take volatility and use it to your advantage in this kind of a market environment. So we're going to look at the charts here in just a second. But I do think it's important before we do that, though, just have a quick moment and understand that the market environment that we have been really since early 2018 has been sideways in the most part. We've seen certain things move higher, so they lower. It's been very choppy in a wide range, but for the most part, stocks haven't gone anywhere. So I'm going to quickly show you a chart for perspective, kind of give you a little bit of perspective of why interest rates matter so much, and then we're going to look at the volatility and how you can use that to your advantage for a quick trading tip. So this here is the chart of the S&P 500, which is the chart that you guys all know of, that I've been talking about a lot here. That's this blue line. And in orange, I guess is what this color is, I have 10-year bond yields, US 10-year notes. And what I want to quickly show you is that we've had this big diversion here between stocks and bond yields. And it's the diversion matters doesn't matter until it matters. And so basically what we've noticed is that the 2% mark on 10-year yields was important. This right here is about 2%. And this broke, I think, late last week. And or maybe mid last week, that's when stocks started to set up and take notice as we broke the 2% mark. So that's just kind of for perspective. Now, what I really wanted to show you is give you a bit of a chart of the VIX. Now this looks like just a nothing chart, but what this really represents is the volatility or implied volatility of the S&P 500. So when the market gyrates, and then when I quickly go back to the S&P chart, one of the ways you can take advantage of this all is by using implied volatility to your advantage. So the VIX, as you saw on that previous chart, let me go back to this. Sorry, I'm kind of flipping around. The VIX has, of course, spiked over the past few days, as you would expect when the market sells off, implied volatility goes higher. Now, the VIX in general, and I'm going to pull this chart back a bit more, tends to have a range between about, let's call it 12 on the low end, and really on average, it doesn't really go much above 30. And that's kind of the range that we've had for the most part, really for about as long as you can remember. Now, obviously, there are outlier periods, but for the most part, that's kind of like the range you can handicap the VIX in, 12 on the low side, and let's say at about 30 or so on the upside. So that's kind of the range you want to deal in. Now, if you look at this even closer, you can see that while 30 might be the higher end of this mark, for the most part, when the VIX gets to like 25 or so, it already gets overbought. So, like right now, for example, I'm going to go to the S&P chart. I'm going to make this I'm going to quickly turn this into a candlestick chart so you guys can see this a little bit better. What you can see here is that we've been gyrating. So as the market got oversold a few days ago, as I've been mentioning in the last video in terms of taking profits on or at least short-term profits in the SPY, it was a good opportunity to sell some puts, or put spreads is really the way you want to do this. And if you're not familiar with this, I will cover that a little bit more going forward here in these videos, because I know a lot of people are very interested in that. So one thing you can do is basically sell, it's all about buying low and selling high. So what you want to do is you want to sell some expensive volatility. So as the S&P sold off and the VIX got up to 25, it was a good opportunity to sell some what I call out-of-the-money put spreads. And that trade, even though the S&P has hardly bounced, is already making money just because implied volatility has come down. So we are basically selling puts or put spreads, i.e. selling expensive options. And by just the virtue of options becoming a bit cheaper, you can then basically buy that trade back cheaper. So I understand this might be a bit of a mind game for some people who are new to this kind of thing, but what I'm trying to show you, and I will cover this much more going forward in these videos, is that if you understand how to use implied volatility to your advantage in the options market, and I know not everyone trades options, you don't have to trade options. This channel is not about options. It is about analyzing the market, but there are ways you can make a lot of money and really kind of, amplify your returns in your broader sort of trading and investing activities by using implied volatility to your advantage in a very, very simple way. So I guess to sum it all up, you want to sell implied volatility when it's high, you want to buy it back when it's cheaper. And so going back to this example, now that implied volatility has gotten a little bit cheaper again, in my opinion, it's a little bit too early, but maybe if we get the VIX back into, and I don't know, this is very, very near term, but maybe 17 or so, maybe then it's an opportunity to buy protection again, buy puts or put spreads, because now it's cheaper again. You don't want to buy expensive options. That's really important, and that's why we made such a big deal on the 29th of July to our clients to buy implied volatility, or i.e. buy puts and puts protection when the VIX was very, very low. And so that has worked out well. So anyway, guys, I hope this makes sense. Have a great day. Any questions, comments? Leave it down below. Thumbs up. Subscribe to the channel. Share the love, and I'll talk to you soon.